panel discussed the importance of investing in emerging markets, mainly through pension funds. And I think this panel will go into a lot more depth on the importance of investing in emerging markets, and also investing in technologies, the right technologies across emerging markets as well. And with us to host this is Gihan Hyde, who is the co-founder of CommUnique. So Gihan, I'll hand it straight over to you to get going.
Thank you, Sammy. Hi, everyone, and thank you, as Sammy was saying, for staying this long. I promise you it's not going to be a boring session. I promise you that, okay? While we're talking, can I please ask you to ask your questions on Slido? Because this is going to be an interactive session. I will ask each panelist one question, and then I'm going to open it to the floor. So feel free to ask as many questions as possible so that we can go through them. Okay, and if you are lost and you don't know where you are, this is where is the name of the session? Never mind. Okay, the name of the session, as Sammy was saying, is Investing in Emerging Markets from Deep Tech to Energy Transition. The reason why this session is important is because the emerging markets are fundamental in embedding and reaching the net zero goals that we all have across the globe. But without the emerging markets, we won't get there. But unfortunately, the majority of the investments that are taking place are actually not in the emerging markets. To reach the energy transition, we have to invest $1 trillion a year to just get to the energy transition plan that we have in place for 2030/50. That's not the case. Currently, the emerging markets are only receiving $2.2 billion a year to get to that place, so we're really behind. And with me, these esteemed panelists, each one of them represents a different ecosystem or a different element of the ecosystem needed to focus on these emerging markets. So without further ado, let me introduce myself first, and then I'll ask the panelists, my esteemed panelists, to introduce themselves. My name is Gihan Hyde, and I'm the founder of CommUnique. What we do is we help organizations to engage effectively with their suppliers and educate their employees and their supply chain in starting their sustainability journey. We are based in the UK, but we operate also in the MENA region and in Europe. In my spare time, which I don't have much of, I am an Oxford University lecturer. I teach sustainable cooperation and business model innovation. I also am part of the Accenture Innovation Lab as their sustainability mentor. So that's me in a nutshell. Please link in with me if you want to know more about the work we do. So without further ado, Helen, would you like to introduce yourself?
Hi. I'm Helen Lin. I am a partner and founding team member at @One Ventures. We are a Silicon Valley headquartered venture capital firm dedicated to investing at the intersection of deep tech and climate tech across all industry verticals, early stages, seed Series A, and with a global mandate. My past life before this, I was working for 8.5 years in Africa in microfinance, delivering financial inclusion products and services to low-income populations in 6 countries on the continent.
Thank you, Helen. Nick?
Hi, my name is Nick Firzli. I'm the director of the World Pensions Council. We're an international association of asset owners and think tank focusing on the bloody crossroads where ESG and financial markets intersect.
Thank you, Nick. Mahesh?
Hi, I'm Mahesh Roy. I'm the Program Director for Investor Strategies at the Institutional Investors Group on Climate Change. So our name sort of explains what we do. We're a membership organisation. We have over 450 members of both asset owners and asset managers, from small local pension funds to venture capital firms to the world's largest asset management firms. And we help them integrate climate change into everything they do.
Thank you. Thank you all. Nick, I'm going to start with you, because you're the bigger picture. You're the pension funds, okay? As the leading voice on global pension funds investments, how do you see the role of institutional investors like pension funds in driving the energy transition in emerging markets? And what are the key challenges and considerations that you take and face when allocating capital for these markets?
Yeah, first, we don't invest ourselves, so we're just an association or industry group, but I'll give you my personal opinion. I think the problem, because as you said earlier, there isn't enough money. So we haven't shifted the trillion. We would like to shift the trillions towards Africa, Asia, Latin America, but we haven't. So I think, there are many issues. I think to me, the biggest issue is the following, is that in finance, a lot of things is driven by indices. So as individual investors, we can, buy individual bonds and shares using the internet, but big institutions, asset management companies, pension funds, insurance companies, they use benchmarks. They use indices like the S&P 100 or the FTSE 100, etc. And these indices, they drive a lot of what's happening mechanically. And it's an oligopoly, so you have two Anglo-American companies who have a combined market share of 98% of indices worldwide. So to make a long story short, if you're a pension fund or an insurance company or a pension fund, you'll be using these benchmarks. Benchmark being another word for index. And the problem is, for many reasons, some of them statistical, some of them neo-colonial, but these indices are tilted. They over-allocate, so they mechanically tend to over-allocate investment towards rich Northern Hemisphere countries. So mechanically, if you're a pension fund or an insurance company, it doesn't mean you're racist or you don't like Africa or Brazil or China. Because you're using these indices, and they favor liquidity, they favor listed liquid assets. And by favoring statistically listed liquid assets, they will push you, want it or not, they will push you to invest more in Britain, France, Germany, America, Canada, Japan, and much less in the rest of the world. And so I think this is the biggest issue, because these indices are a reflection of the economic strengths of the world's nations 20, 30 years ago. So they really very brutally underinvest in Africa, Latin America, and Asia. So I think that's something to keep in mind. So my message to you guys is, investors need to break the shackles of benchmarks. If they want, if they need, if they're sincere and serious about investing more in the Middle East, Africa, Asia, South America, they need to go beyond the index, get rid of the index, build your own index. And something else is, leapfrog. So, move away from listed assets. Don't invest that much in large listed assets. Invest more in non-listed assets. And the governments, the regulators, have a big part to play, because it's a double whammy. It's not only the government, it's the financial regulator. The pension regulator here in London forces or pushes pension funds and insurance companies to invest more in liquid and listed. So if we fix just that, only that, that will mechanically free up trillions of dollars or pounds to emerging markets.
It's interesting when you say break away from the indexes and just do your own. So Saudi Arabia have just launched a new ESG ranking tool that is only for emerging market based and born companies. It's called Inclusive ESG. Check it out. They are competing with S&P, Fitch rating, et cetera, and we helped them to launch it. And what was interesting is that the data sets that they've been asking companies to report on based on the infrastructures of these companies in the market are completely tailored to their countries. So it's worth definitely checking them out. Okay, I can see a lot of questions coming in. I think one of them actually, Helen, is ideal for you. The question is, how do you get Western-based VCs comfortable with emerging markets risks, such as lack of transparency, currency risk, among others?
That's a good question. I think the short answer is you don't. It's having actually worked on the ground in some of these markets, and also being very clear that one emerging market is not the same as another emerging market, which I think some people want to draw that parallel. You can't invest in these markets unless you have on the ground knowledge. You have boots on the ground to support practically. And so we make investments in markets in regions like Africa, but we partner. And so you find the people who are there on the ground, who do have that on-the-ground expertise, who have those battle scars and have failed at a lot of things and know, what it takes, what works and what doesn't there. And those are the people where when I have a crisis in my company in Kenya, I can call up my co-investor and say, hey, can you just pop over to the factory and try to help them out with this?
Oh, really? Okay.
So I would say go in, I don't want to discourage people. The point is yes, we have to I completely agree with your opening comments. We absolutely have to be investing as Western investors in emerging markets. And also, we have to be doing it in a way that's practical and makes sense, because the more people who get burned doing it, the more they send up these signals that, oh, it can't be done.
Okay.
Right? And so you got to partner with the right people so that it can be successful and show people that, yeah, there is a way where you can get into these markets and still make a decent return and not lose your shirt, on your investments. And you got to show the world that that is possible. But you have to be really pragmatic and prudent and have those relationships on the ground.
Thank you, Helen. Mahesh, I'm coming to you next. What are some of the key policy and regulatory reforms that you believe are necessary to create a more favorable investment for the energy transition in emerging markets?
Thanks. Yeah, and I'll probably sort of build off both of the previous comments as well. I think there is probably some policy and structural reforms that will help, and I think Tony on the previous panel at Make My Money Matter talked about some of those at a high level. But I think a lot of the structural issues there aren't so much baked into policy or necessarily policies that can change, because large investors, people that organisations that invest on behalf of beneficiaries of pension funds or people with insurance policies, etc., they have a fiduciary duty. So they, some up-close paparazzi happening here.
I've only seen this in this lovely panel. I've never seen this before.
That's fine.
Keep on doing it, Nick. We need the pictures. Yes, please.
I need the pressure. It's late in the day, you know what I mean? You're making me put on my best face and ramble about, So where was I? Oh, no, so the structural issues is really that they have a fiduciary duty. So then that goes back to different types of theories of investing. So modern portfolio therapy, modern portfolio theory, and the need to diversify risks, the need to aggregate risks, and also the amounts of money that they have. So these large allocators of investments don't have time, don't have the resources. Pension funds are effectively not-for-profits. They're not on massive bonuses, etc., and have large swathes of team to move large amounts of money into different pots. So I think a symptom of that is what's been explained here, is that they then get attracted to easy investing into benchmarks, indices, etc., etc. And if they continue to provide returns, which fulfills their fiduciary duty to protect the long-term wealth of their beneficiaries, etc., or other prudential regulations for other organisations, then they'll continue to do that. So there is a mould that needs to be broken. But I think in the work we do, and in the hundreds of investors I talk to all of the time, they understand that the energy transition and decarbonisation needs to happen globally, or otherwise we won't meet 1.5 or even well below 2 degrees, etc. Developing economies, frontier economies, emerging markets will be those that do need and deserve to develop will be the ones that put those emissions into the atmosphere that will tip us over. Not the ones that started it, but the ones that end it. So that transition needs to happen, so they do recognise that. So, downstairs, Jeremy Hunt spoke about the government and some of their net zero plans, and he received a lot of criticism from people in the crowd, but something good that he did recently in the Mansion House Pact was about British businesses, but that was urging all defined contribution pensions in the UK to allocate 5% into venture capital in the UK, backed by the British Business Bank, so de-risked by the British Business Bank as well. Now, a policy intervention like that for an asset allocation for climate-conscious investors to allocate 5% to emerging markets, new technology, etc., that was de-risked by, say, British International Investment or other multilateral institutions, and sort of putting those sorts of interventions together can then make it easier for institutional investors who need to move big amounts of money into pools of capital. So, maybe a secondaries fund of venture capital funds that's diversified over a lot of different countries, so they can actually make it easier. So policy definitely has a role to play, but a lot of the barriers, the structural barriers, are perceived and based on I guess, regulation that's very hard to take away. I guess most people here with pensions don't want necessarily all of their money to go into sort of illiquid venture, capital investments in any place, let alone in markets that aren't understood. So I think policy has a massive role to play, but it's not necessarily in regulation. It is more about in how it can catalyse it, and maybe like some of those good ideas in the Mansion House Pact is look externally and look what Western investors can do for the rest of
But I also think it's also our role to educate ourselves on where the money is going from our fund, from our pension, and it's our role as well to put pressure on these pension funds to not invest in things that we don't, assets that we don't believe in. Nick, I have a question for you. By the way, there is tons of questions coming over. The question for you is, do banks or asset owners' net zero targets currently help or hinder greater climate investment in EMDEs?
World Bank acronym, which means emerging markets and developing economies.
Thank you.
Because we thought it was offensive. In the old days, I'm old enough to remember, we used to call them least developed countries, and somewhere down the road it was deemed insulting. It became DEs, and it's a way of slicing the emerging market world in two, saying that there are rich or fairly developed emerging markets, and the very poor or the least developed are called DEs. So EMDEs, does it hinder? Net zero is about symbolism. So I don't think it's good. I don't think it's bad. That summit is called Innovation Zero. So I think it can be good symbolically because it strikes our attention. And it forces governments, but also people, voters, to focus on something tangible. So if we say, okay, we can measure blah, 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 carbon, blah, 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 and we want to reach net zero by 2030 or 2035 or whatever year, it actually gives a fairly rational metric. So I think from that perspective, net zero, why not? Because it crystallizes, summarizes a lot of things. Now, is it a magic bullet or silver bullet? No, of course, because things are complicated. Life is complicated, as teenagers say on Facebook about their matrimonial relations, but it's ESG is very complicated, and it's hard that the metrics are not there. I'm French, but not everything is measurable using, inches or meters. And the problem is a lot of things cannot be measured. So at least, if we say net zero, carbon emissions is kind of measurable. So why not? I think once again, the biggest thing is not having, a buzzword or a buzz objective like, net zero by the year, whatever, 2041. The biggest thing to do quickly, because time is of the essence, is to change regulation. So don't punish, Basel II, Basel II, Basel III, Solvency II, Solvency III, the regulation which we put on the shoulders of pension funds, insurance companies, are very counterproductive. And so from that perspective, governments are schizophrenic, because, Jeremy Hunt is a nice chap, and he's going to tell, pension funds and insurance companies in the City of London, you guys should invest more in infrastructure, private equity, venture capital in Britain, help, the UK economy post-Brexit grow, and do the same in emerging markets. But the same Jeremy Hunt or the Bank of England or the regulator will tell the same insurance companies and pension funds, no, you have to invest more in liquid listed bonds and stocks. So I think governments, not only the UK, like all governments, should fix that, have a coherent policy. If you guys in Whitehall really want pension funds and savers and insurance companies to put more money into smart capital, creative, deep tech, high tech, in Britain and in emerging markets, change the regulation. Just do it.
Mahesh wanted to add something?
Oh, sorry, yeah. Just to answer that question directly, and just only because it's something that we work on specifically. We helped found the Net Zero Asset Managers in 2020. We developed the Net Zero Investment Framework, which is the most widely used framework by investors globally that have committed to net zero. And in answer to the question, do they help or hinder investing in emerging markets? I'll most honestly say yes. Yes, they actually do. We've found out after about 3 or 4
Do what? Help or hinder?
They hinder.
Okay.
They do hinder, sorry. After about 3 or 4 years of implementation, so we've helped hundreds of investors that manage trillions of dollars set these targets and start to implement these targets. And we've noticed that focused on what are known as financed emissions, which is sort of when you abstract out the real economy emissions and allocate them to a piece of finance. If you look to reduce them at the rate that the world economy, the global emissions should in a discrete portfolio, then you basically are not going to invest in anything with any emissions increases or high emissions, like emerging markets, like climate solutions, etc. So it's a very blunt instrument. And so we've learned from that. We're releasing an updated version of the Net Zero Investment Framework 2.0 in a couple of months' time. We have an emerging markets workstream to look at this particular problem, because all of the investors are saying, we want to put money where the problem is, but if we do that, we blow our targets out. So I think it intuitively you think, well, high portfolio emissions should get low and that will get the world to net zero. It won't. They're financial portfolios. New technologies, new investment, low carbon growth will get the world to net zero, and financiers need to do that. So I think those of us, and I am one of those people, who've helped proliferate these net zero targets, need to take this into account and adjust course to make sure that money flows where it needs to.
That actually takes us to a really good question that came off, and that would be for you, Helen. How do investors solve the lack of granular data in emerging markets? And how do you measure your impact in these markets?
Environmental impact?
Yeah.
Or other forms of impact?
Let's do, if you can, environmental and social. Because there is a question around human rights as well.
Okay, so, I mean, to be frank, there is not a lot of granular data that is actually that credible even in non-emerging markets. So, I mean, I think in general, there's like a macro comment that needs to be made where people tend to view emerging markets as being higher risk and so much more dangerous, and there's all these other exogenous factors, and they don't actually reflect and turn inwards to look at their own markets to recognize how risky and how many crazy black swan exogenous factors might arise in their own markets, right? I mean, like, we have a huge portfolio in food tech and ag tech companies, for example, all American and European companies, and anyone in this room that has invested in food and ag tech in the past couple of years knows that the bottom fell out of that market, right? And nobody saw it coming. And all of those startups are currently like on life support, right? And that they were US companies, they were European companies. So those things can happen just as easily in developed markets as they can anywhere else. At least when you invest in emerging markets, you're a bit more on guard, right? And watching out for these things like the currency risk and that the other questions were about. In terms of granular data, as a technology investor, I'm going to put this specific lens on it. We take the same approach for data and impact measurement in emerging markets as we do in developed markets, which is we look at unit economics. So if you know that a new technology or a new product we call it physics fundamentals. So everything in the world can be distilled down to matter and energy moving through space and time. Come with me on this. And if there's a new technology that gives you a fundamental win in reducing the matter used, the energy used, the space used, or the time used to produce a thing, it will fundamentally give you a cost win as well as an environmental win. That is a fundamental truth in nature, whether you're in the US, whether you're in France, or whether you're in Kenya. Right? And so, for example, we have a company that's just doing electric motorcycles, and they've just designed a motorcycle that is more built for market. It's bespoke. It just uses better parts. It's charging on a grid in Kenya that's 80% renewable, so it's more green to charge an EV in Kenya than it is to charge an EV in the US, by the way. Right? And so there's all these fundamental wins where every motorcycle that is pushed out is going to be like 100 times better for the planet than its conventional ICE counterpart, right? And so you don't need to get down to this granular level of academic calculation, because at a unit level, there's a fundamental techno-economic physics win. And then you use sales as a proxy for impact. So every single unit of sales of that motorcycle that you push out is going to then have that unit impact, and then you just push sales and you grow the wheels off that.
And what about the social impact? Do you measure that at all?
Social impact is definitely harder to measure.
I know, that's why I'm asking.
Yeah,
Do you?
yeah. So there's what are called intermediate KPIs, and then there's outcome KPIs.
Okay.
Intermediate KPIs would be, for example, saying, like at my old firm, oh, we've given loans to 1 million banking customers with our microloan product that's designed to help lift people above the poverty line. But the outcome KPI would be, okay, but did that work? Right? Just because you gave loans to 1 million people, that was meant to help them start a business and increase their livelihood and increase their average income, but did that actually work to like reduce the number of days their children go hungry, or to give more educational opportunity to their kids, or get them out of this vulnerable kind of financial position that they're in? Those metrics, when you do measure them and you pay money for studies that measure them, often result to show that you're not actually having the impact that you strive to have, because there's other factors in the mix.
Okay.
And so I think that is a challenge for social impact measurement, which could be the topic of a whole other discussion for a different day, is, there's a lot of other factors that obscure the data there.
Would anyone like to add to this before I ask 2 more questions, because we are definitely over? No, we're good? Okay, Mahesh, this is for you. The market won't solve here. How about indigenous... Sorry, that's for Nick, apologies. The market won't solve here. How about indigenous sovereign wealth funds to kickstart and match fund an element of risk? Does that make sense to you?
Well, let's say that the growing role, let's keep it simple, the growing role of sovereign funds from emerging nations, yes. So the balance of power is shifting in many ways. So for things to change, for the world to change, for financial markets to change, you need money, right? So the more money you have, the better it is in many ways. And so the fact that in relative terms, countries like Abu Dhabi, Saudi Arabia, Singapore, China, Indonesia, Malaysia are richer than they were 10, 20 years ago, that is great because Asia, Africa, the Middle East, Latin America, with a few exceptions, and these exceptions would be South Africa, Brazil, Singapore, but with a few exceptions, they don't have many pension funds, unlike us. So unlike us, Brits, Dutch, Canadians, Australians, Americans, and these are the pension superpowers. And there are only 6 or 7 countries in the world, and France and Germany are not among them. Only 6 or 7 countries in the world who have a lot of pension money, including Britain, Canada, Australia, and Holland. And so they are the the richest investors in the world if you focus on the Western world. If you focus on the global South, they don't have many gigantic pension funds like they do in Toronto or London, but they have gigantic sovereign funds. So in a way, SWFs, sovereign wealth funds, are allowing the global South to have their say. And a good example of that is Saudi Arabia, a country where Gihan was 5 days ago. So Saudi Arabia, until like 6, 7 years ago, they were not very active investors. And all of a sudden, with the Crown Prince, in just 5, 6 years, it's a game changer. So they're now so big and so active that they're co-investing jointly with Chinese, Singaporean, Mexican sovereign wealth funds. So it's amazing, and it all happened in the past 4 or 5 years. So the global South is getting organized, and I think it's good that they're becoming richer. It doesn't mean that we're becoming poorer, but in relative terms, some countries in the global South are becoming richer, and it creates balance because the world needs balance. So if you have more diverse investors, it's also great for ESG and climate finance because competition is good. So if some capital is coming from Riyadh or Singapore, competing with capital coming from Montreal and San Francisco, it's good because the emerging markets in the middle, they can profit from that rivalry in a way between global South sovereign funds and Western pension funds. So I'm fairly optimistic about that.
Perfect. Thank you. Mahesh, last question before we bid everyone goodbye. Shouldn't net zero targets be intensity-based to allow for an absolute growth in EMDEs?
They could be. I think there's many different ways to look at. So you're talking about intensity-based targets that are based on...
I don't understand what that question means. Can you demystify it for us?
I would say that, yeah, looking at intensity, so that's looking at basically, you know, emissions divided by a denominator of a number of sales or an economic output, like things produced, which allows then for growth. So basically, a smaller company, you know, can grow exponentially with low emissions. Can grow, their emissions will go up, but the intensity might stay the same, or might even decrease if they decarbonise well. I think yes, that's one way to look at it. I think another way that we're currently looking at it as well is around pathways or regional or country-specific pathways. So currently, when investors or financiers look, in many cases, look at assessing a company's alignment, they look at a global pathway or maybe even a regional pathway, a regional sectoral pathway. Those pathways are based on the cumulative emissions on the atmosphere and moving forward, like the IIGCC, that is a global pathway of emissions reduction. Now, emerging markets, so take India for example, you know, 1/5 to 1/6 of the world population, currently responsible only for 4% of emissions, with hundreds of millions of people still living in poverty. And probably an argument that a lot of their IP was taken by, you know, the country we're in now, and sort of had their growth stopped. Now, for them to grow and develop, they will increase their emissions. Should companies in India that are looking to grow be assessed against these global pathways which reflect everything that's been done until now? Or is there a more nuanced way to look at it that brings into what the UN call common but differentiated responsibilities? So everyone needs to decarbonise, the whole world needs to decarbonise, but the reason for decarbonisation probably sits on the shoulder of us in the developed world, where we're bearing the fruits of all the carbon before. So I think there needs to be nuanced ways. Intensity is one metric. Intensity can always be troublesome, particularly if it's got a number or a dollar-based denominator. You've got currency fluctuations. You've got all sorts of things that require normalisation. That can help smooth it out. But also, I think looking at specific countries and country pathways and sectors in those countries, and looking at what the fair share responsibility of that country is, and if there is a carbon budget we all need to follow, where should growth be, in which countries should it be, and where should we encourage that growth? And I'm not saying that we slow down growth, but growth should happen in a lower carbon way for countries that have already benefited from carbon emissions in development. So I think intensity, yes, that's one way of looking at it, but there's probably more nuanced ways investors can look at it as well.
Perfect. I am so sorry we kept you longer than intended, but the fact that you're here, that's a good sign. We must have done something right. Thank you so much for everyone who has attended. Thank you. If you want to connect with the panelists, these are the names. Please do connect to ask them as many questions as possible later on. Take care. Have a lovely journey back home. Take care.